And here we go. All right, welcome back to Stacks Matt. The numbers. Hold on, let me close this window in. Okay. And I wanted to do a video here on this Toast Incorporated symbol TOST listed here on the New York. Now, this stock has technically been rocking and rolling when it comes to revenue. This is a software service, kind of like like the touchscreen POS systems at restaurants and whatnot. And supposedly, it is obviously a pretty hot product and service because the market cap's here at a touch below 22 billion, and the company has been not only beating EPS more times than not and increasing profitability, especially over the last 3 out of 4 quarters, but also we can see that the revenue here a couple of quarters ago looked very slightly above 1 billion, and now boom, 1.24 billion, 1.3 billion. And you can see the net margin percentage. Look how close it was to flatness just a couple of quarters back. -3%, -3.5%. Big dip there, -7.7%. Then we get the little bit extra boost, jumping up from 1 billion to about 1.25 billion revenue, and that puts them over the top, bringing in 14 million or roughly 1.1%. And now you can see for last quarter, revenue 1.3 billion, net income 56 million, bringing in over 4.25% net margin. So technically, this company is really on the up and up. And I'd say that it just kind of dipped underneath the radar and probably frustrated a lot of shareholders simply because they took the highest price they could coming out of the gate, as you see. Stock went public here, tail end, right? Where was it? Yeah, tail end of 2021. You can see, some hype initially dropped, had a pop higher, and then just went in free fall. Little bit of a rally, we kind of consolidate a little bit, we wedge down into earnings here, and then boom. Since then, we've been on the up and up since the tail end of 2023. So 2024 has been the breakout year for Toast. And reason being, in my opinion, is because now the market cap came down to earth and readjusted while the company was consistently building up the business, beating estimates, and then all of a sudden it was undervalued. And then all of a sudden, they keep raising guidance, and then all of a sudden they keep beating earnings. So we just take them up and up and up. But recently, the stock has pulled back a little bit, and we recently hit highs of a touch over $44 a share here, 44.12. We can see the stock pulled back down now, technically below the 20-day moving average for the first time since early September. And in my opinion, just looking at the technicals, we do, of course, have this gap fill. We're looking at about 33. And, of course, we kind of had this upward channel and then a continued breakup here with these earnings. Very good quarter for the company. We go back about 4 weeks ago. We can see they beat on the EPS side, 17.5 cents a share. Estimates were 14.5 cents. And of course, the revenue estimates jumped up to 1.29 billion. They post 1.3 and beat revenue estimates yet again. And we can see if we go back, again, we had a couple of misses here on the EPS side, but even going back to early 23, you can see that the revenue has never been an issue. All of these quarters, even here with the EPS miss, estimates jump up to 1.04 billion, company posts 1.07. And then as again, we jump up to the next milestone, close to 1.25 billion, the company's able to still beat these revenue estimates. So almost like what we saw with Celsius early on, the fact that they're just consistently beating these estimates. And we can see that next quarter, 131 billion. I mean, based off of what we've seen over about the last 2 straight years, I would say, in my opinion, I'd give the company the benefit of the doubt. However, after running so much, of course, ideally with the stock here at 38, you'd love an entry here at like 28. And of course, it could happen, but I'd say realistically, look for this gap fill now that we crossed the 20-day moving average. So if it remains a little weak and kind of just like channels down going into next quarter's earnings, slated for about the second week of February, we can see a channeling down, we can see a gap fill, and then if they beat again, boom, you bring it right back up, right? So that's why, in my opinion, I would probably wait for, like a 5-6 point sell-off. Personally, I would try to enter this at around 33, sub 33 if I could. And even if I did begin to piece in there and it just continued to drop down to this fib here, 26.75, well, again, if we liked it at 38, 33, then if it drops to sub 30, you should technically like it even more. Now, of course, because it ran up so much, if the company happens to miss this revenue mark, then yes, it's probably going to tank down to the low 20s. However, the long-term growth and the consistency of the business has been pretty solid. So that's why if you're able to hold on for the longer term, initially buying in the mid to low 30s, and then as we said, if this happens and they miss earnings and it drops to the low 20s, if you're able to, you can always add to the position and just hold on for the next 6 to 12 months. If you're looking for a trade right now on Toast, in my opinion, I do think it goes down before it goes up. However, of course, you could make this argument with your trend lines as well. 34.70, right? You could like come down like that. So you can say like we recently came down, we bounced, we had a little pop and we dropped. So now we might pop back up here to potentially form like this triangle, right? So it might immediately pop back up to almost 41 and try to retest this 20-day moving average. So in the immediate short term, I mean, technically could go either way. However, we did just have a big drop and we have like, some slight channeling upward. So we could potentially be forming a bear flag here, which is why I'm saying we might break down and try to fill that gap. Because technically the business has been growing, but it could be viewed as overvalued in the numbers. Again, $21.75 billion market cap. EPS has been very healthy, beating estimates 3 of the last 4 quarters. Revenue hasn't been missing at all, and we can see that the company recently went net income positive 2 quarters ago, which of course adds even more value to the situation. If we look at last year, we can see revenue 3.87 billion, slightly negative, losing about $250 million or roughly 6 1/3%. But now obviously for 2024, we had this rough first quarter, and then we basically just washed out this loss from these profits here over the last 2 quarters, which means if we post basically a similar quarter, right? Let's say we just post in line. We post 131 billion and they bring in another, 58, 60 million. Technically for 2024, they would then be net income positive. So if we look at the current situation, let's just give them slight positivity. 107,124 is 2.31 billion, 3.61 billion, and then we'll say 4.92 billion. Which technically is about, 30 plus percent. No, excuse me. That would be, that would be like 25% growth in revenue year over year, which definitely isn't anything to sneeze at. But so that would bring us to like 4.9, slightly positive income, 4.9. Okay, keep that in mind. Again, we're looking at 2024 revenue and potential profits when we're trying to calculate now our quote-unquote fair value. But you can see revenue's been solid, EPS are mostly solid, and even over the years, the company is consistently coming in above expectations. And you can see 4.94 billion. So yeah, we just did that math, and we came up with about 491, 492. So this mark of 494 might actually come in light. But then again, the company has been beating pretty handsomely here by, a mix of like 1 to 3%. So here on 131, we could potentially see like 133, 135, and maybe they'll meet that mark or come in above this 494 billion. So only time will tell. But again, based on what I'm seeing, in my opinion, I'd give the company the benefit of the doubt. But the good thing is the cash on hand looks very healthy. And of course, over the bump up in revenue over the last 2 quarters, you can see the cash made a big jump as well. So we were holding high fives, 600 million. 2 quarters ago, 691 million cash on hand. As of last quarter, 761 million cash on hand. And as we saw over the last couple of quarters, especially in the tech sector, what we were seeing is that because of the devaluation of the dollar, basically we were kind of potentially overly rewarding high profit margin stocks that have a decent amount of cash on hand, right? And they're sitting here with good financial health, so to speak, right? So those are the ones that didn't get beat up as much, if you noticed. But technically, growing very nicely, growing their cash pile. And even if we look at the free cash flow here, we can see positive 97 million for the last quarter. And if you go back a year ago, you can see free cash flow positive 48 million. So the free cash flow has essentially doubled. The debt hasn't really moved too much. Went from 32 million to 44, slightly ticked down. It's sitting here at 38 million, right? That's a drop in the bucket. We have more than enough cash on hand if we did have to just pay that off real quick. So 38 million debt minus the cash. I mean, you're left with like 720 million. And we put yeah, what did we put? Like 4.9 billion. So now you're at like 5.6 billion. We have assets outweighing liabilities heavily in both the short and the long term. Equity consistently growing from 1.1 billion up to about 1.4 billion now as of last quarter. And yeah, that would put, in my opinion, that would put quote unquote fair value of this business at roughly 7 billion. And the market cap right now is a touch over 21 billion, meaning that we're trading only about 3 times quote unquote fair value, which means if everything continues the way it is, then over the longer term, you will eventually see 4.5, 5 times quote unquote fair value. So if nothing changes in this business over the next 12 to 24 months, I know it's a long time, but again, I want to try to be conservative when I lay out my personal price targets. If everything stays the way it is, you can easily see a 28, I'd say like 28 to like $31.5 billion market cap, which of course is roughly another 7 billion or, plus fair value chunk up on this stock, which would be about 33+%, which would be 13 more points, which would bring my personal price target, you know what? We'll make a random round number. I'll go 52.5 in my opinion. 52.5 long-term price target. Long-term price target on TOST. Because again, in the short term, in the technicals, we do have a very strong argument to go down before we go up. Because we've seen other stocks with healthy fundamentals like this that are also, getting held down. They might only be trading 1.5, 2 times fair value. This stock recently went on a big run up over the last couple of quarters. Now we're up to 3 times fair value, right? So now we might sell off. We might pull back to like 2.5, 2.3 times fair value, bottom out, and then gain a little momentum going into February earnings. And then if they beat again, boom, you see the pop, and then, it'll run back probably to the high 30s, 40 plus. But again, from like a day trading perspective, could kind of go either way. We made the argument back to 40 for the pop up to the moving average. And we could also make the argument that now we may come back down and just kind of channel a little bit here, potentially forming this flag, and then break for the gap fill down to, what was this? 33.01. Okay, so essentially 31. Wait a minute. Oh, no, that wasn't a gap up. It almost looked like a gap up. Oh, no, that was a gap up. High 32.15, low 32.33. So we technically had a gap up and then a bigger gap up. And I understand earnings was the catalyst. That's very understandable. But I mean, if gaps always fill and we just had the big run up and now we're pulling back, I mean, it might be due for a little sell off. That's why I'm saying we might break, gap fill, and then bounce and just kind of maybe channel down going into next earnings. You understand? So in my opinion, that might be what happens here. That's why something like TOST, again, my long-term price target, I think it could get up to above 50 if you give it some time. In the short term, though, personally, if I did have cash on hand to buy this, I would look for a better entry. I would look for the low 30s, potentially, obviously, sub 30 would be ideal. But it does look good in the numbers. I will say it does look good in the numbers. And even if we come over and we check the actual stats, we can see price to sales up to almost 5 times sales. But again, all these numbers have been growing. So even a ratio 5 times sales may not be viewed as too overinflated. We're trading 75 times cash flow. If we do look at, past performance, which again, past performance never dictates future results. Well, it's not never. It's, the saying is past performance doesn't dictate future results. But again, you understand what I'm saying. But if we look technically back at what happened last year, you can see next quarter, the price to cash flow ratio jumped from the low 70s to 80. Now we're in the mid 70s. So again, if we see a bump up, that's why I'm saying, 3 months from now, if the stock's at like 46, I wouldn't be shocked either. So That's why, again, could kind of go either way, but short term, I think down, long term, I think up. We're trading almost 15 and a half times book value, right? So this is the highest it's been going back the last, 8 or 9 quarters. And we can see that it's technically twice as much as it once was. But I mean, technically, they're doing the business and bringing in the revenue, and recently went net income positive. So again, to pump up some of these ratios can't necessarily be too frowned upon either. What's interesting is the enterprise value. Again, what another business would be willing to pay for it is about $1 billion less than the current market cap, which is why I'm saying, again, with the gap ups and the recent run that the stock went on, I think we go down before we go up. But technically, the business looks good. All of our return percentages look slightly negative now. We were minus 30%. Now we're minus 3%, 2.4%. So they're all looking good. The gross margin was in the low 20s for about 5 quarters in a row. And now with the bump up in revenue, you can see we jumped up above 23, maintained 23. As of last quarter, got to the high 24% mark. Technically, that is a big green flag. The operating margin, I think this is the biggest green flag. Stock went from negative double digits up to positive last quarter. Positive 2 quarters ago, and now for last quarter, 2.6% now. So now we have positive operating margin, which means, in my opinion, if we can at least hold this 1.2 and change to 1.3 billion area of revenue, this stock technically should be more than fine. So of course we know that earnings are a big thing, but as we always say, we have to reevaluate every situation from quarter to quarter or as news hits. So right now, I personally feel bullish on it over the long term. But again, if we randomly start missing on revenue and they start losing market share or something like that, right, we're going to have to reevaluate the situation and come back to it. But right now, it really does seem like, seeing this big U-turn recovery in the stock over the long term, in my opinion, does make sense. And that's why it hit the tape at whatever, the high 40s, the 50s. So that's why, I mean, you can see, look, day one, what is that, 58? Day one low, 58.21. So again, this time next year, you could see that level again. You could see that IPO level. But even conservatively, you can see at these bottoms where it pulled back, you're looking at the high 40s. You're looking at 48, 49 and change. So that's why, if you're sitting there saying, oh no, it'll get back to 50, I'm thinking like 53, like, yeah, it's understandable. I can appreciate that. So that's why, it's unfortunate. You know what? It's funny because something like this, right, obviously aggravates shareholders. And some of you may have lost faith and now you're seeing revenue climb and the stock's going back up. So you might be kicking yourself. But the one thing I will say is this reminds me of Facebook. Again, I told you guys I was a broker for a few years. I was there. CNBC obviously was a whole big thing because Facebook was huge, right? And when they went public, Facebook, if you were following the news while it was going public, they consistently kept increasing their IPO price range. And I think it was initially like $17 to like $21. And then they were like, oh no, 24 to 28. And it just kept going up and up and up and up. I think it finally got up to like $38 or $42 or something like that. So what happened? Stock came out, dropped down to $17. So if you jumped in from day one, you might have lost faith. You might have thought it was overvalued, and you might have just sold the position for a loss and then decided to come back to it down the road. So that's why, again, it's an unfortunate situation because this is actually turning out to be a pretty decent company. However, they are kind of guilty of doing what every company basically does now, which is take as much as they possibly can coming right out of the gate and not worrying about shareholders' initial reaction. And they try to make it up to them over the long term. So, I mean, again, it's business. I mean, if you offered me an extra, 10 billion and I was able to price it up here, yeah, of course, I would take that as well. I mean, come on, let's be serious here. But, it's just unfortunate. This is why I say, especially with IPOs, look at what they're valuing it coming out of the gate and then look at the actual business that they're doing. And if they do a $30 billion valuation, but they made like $100 million last quarter, then you might not have to jump on it just because it's an IPO. Because chances are it'll slowly, come back down to earth, come down to quote unquote where it should be, and then it'll bottom out. Maybe you'll see some life, and And then again, perfect situation, right? Kind of just hanging out here up and down for like a year and a half. And then all of a sudden now it's undervalued and everything's getting better and boom, it's a buy, it's raging. Right? So that's why I have that kind of realistic, grounded approach when I value a company. But that's just me. I know we're all different. But what were we looking at? Yeah, we were looking at the stats here. Quickly. Yeah, operating margin went positive. EBITDA, again, went positive 2 quarters ago, 1.7%, now over 3.5%. Net margin we looked at closed up over 4.25% for last quarter. Phenomenal. Inventory turnover up huge, going from the low 20s. Now we're up here to the low 30s. I mean, again, not, a main metric that should be, the tell-all behind the stock, but of course it's good to see. Asset turnover growing nicely, steadily. The debt really hasn't increased over the last 4 or 5 quarters. So with everything else, the assets, the equity, the revenue, all of that consistently increasing, our debt ratios are coming down. We don't get paid dividends. Again, EPS, we had a miss a couple of quarters ago, but if you go back, the last, 8 quarters, you can see 2 misses, 6 beats, not bad at all. And as we said, the revenue has not been an issue at all. The company has been growing its footprint very, very nicely. I think on the website it says like over 120,000 restaurant locations I think it's in now. And, they post like the testimonials from the business owners like, oh, the average check size is up like 38% since I started using TOST. So technically, it seems like it's good for the owner. And there's also, if you go to the website, there's also like a loyalty kind of program embedded into the software, and you can like keep track of like your regular customers and little points reward programs and stuff. So if you own like a coffee shop, I guess you see a regular customer, they earn a bunch of points, you get a free coffee once a week or something like that, right? So it's a situation where kind of like everyone's making out, right? It's benefiting everyone. It's more efficient for the client. It's more efficient for the customer. And of course, the customer, again, you get your little perks. So that's why it's usually when you're able to formulate a product or a service that's able to do that, kind of benefit like all parties involved, usually that's a winning formula. So that's why, like this time next year, we'll give it another 3-4 quarters and we'll see if the revenue stays up and up and they keep growing the business and their footprint. Because if they do, that's why, again, getting back to those IPO levels, very, very feasible in my opinion. Yep, even their subscription services, you can see jumping up very nicely here, especially out of 2020, but 100 million to 170 million, we'll call it, almost doubling, 3.25 million, up to about 500 million for 2023. And of course, being that revenue has been increasing throughout 2024, I would assume that number is up as well. But right now we're just in the US. And if we look at the forecast real quick, we can see that apparently this one is heavily covered. And we have 26, 7, 8, 9 analysts, 29 analysts covering the situation, 11 giving it a strong buy, 1 giving it a buy, 15 saying to hold, 1 sell, 1 strong sell. That's actually pretty mixed compared with a lot of other stocks that we see, right? Usually everyone just says like buy or hold. But all right, I respect the people playing the opposite side of the fence. But again, in my opinion, the fundamentals are too strong. So this, like these sell ratings, personally, is for short term, for the traders, right? Big spike up, retrace back down, and then maybe bounce again. So in the short term, I agree with that. Over the long term, even at the current valuation after running, I don't know if I would agree. I wouldn't even agree with a hold, honestly, in my opinion. This is a $50 stock. This is going to be a $50 stock, in my opinion. And again, I apologize. I know I'm personally saying that matter-of-factly. Again, this is not financial advice. It's just my personal opinion. Please do your own due diligence. Understand the risks involved. But I said my piece. Let's check some recent news real quick. Maintain market perform. Price target raised to 40 from 29. Toast and Uber expand collaboration on restaurant delivery. Yes, you can also obviously get the orders for Grubhub and Uber Eats and all that. Said Thursday they expanded their partnership, integrating Toast delivery services and Uber Direct. With the integration, restaurants in the U.S. can save on delivery fees, which again is everyone's main objection to getting food delivered off of these apps. Enlarge their delivery radius, which obviously means more business, more customers, and use the Uber delivery network to offer local delivery of phone orders and orders made through Toast digital channels. Have collaborated since 2021 to deliver orders made through the Uber Eats app. And of course, I'm sure it's benefiting both of them. D.A. Davidson downgrades Toast neutral to buy, average price target of about 40. D.A. Davidson price target cut to 38 from 44. Again, possibly in the short term, I could agree. We're reading. Goldman Sachs downgrades neutral from buy, raises price target to 45 from 34. This was about a week ago. 34 to 45. That's what I mean. They know there's value there. They know there's value there. We're reading. TOST Analyst no longer. Is among the quote best share gainers in the payment space. Analyst downgraded the stock. The inflection in operating leverage has played out, with the company significantly curtailing costs into 2024. Business confidence is improving. Elections. Market pricing, quote, has become a key theme in 25, and Toast seems among the well-positioned companies in terms of revenue mix and exposure to small and medium businesses. I just don't understand, especially since this is technically a long-term analytical outlook. I don't understand. And this guy's an analyst at Goldman. All right, I don't want to beat people up too much. In my opinion, I disagree. I agree with the price target. I disagree with the opinion, and I would personally have a buy rating on it. Again, me personally, short term potentially down, long term should be up. In my opinion, I wouldn't have cut my buy rating. We're reading. Right. If we draw out some trend lines here, we can see low 1380, 1380. What was this low? 1382, 1377. So if we, if we see a big pullback, that's why we don't even need to test this fib, right? You can see we can gap fill, we can potentially channel down, right? And then we can hit this mark right here. Looks like the mid to high 29s maybe. If it happens right away, you're looking at about 28 and a quarter over the next couple of weeks, 28 and a half. If it takes its time, it can channel down here to slightly sub 30 and then bounce off this support level and climb on anticipation of an earnings beat, and then boom, potentially pop back up into the 40. You understand? So we have to see how it performs on the technical side, but in my opinion, those are some of the levels to watch there. And let's look at stock charts quickly. I'll let you go. On the daily, we can see, yep, RSI completely topped out, and then we drop down, possibly forming our bear flag. RSI completely flattened out, middle of the road, slightly sub 50. Bottom Bollinger Band 37, but we can see 34.23 on the 50-day. Which is about a point and change off of our gap fill, which means if we bear flag and break to the moving average, they may just immediately bring it down to just force the gap fill so they can bounce it. 200-day moving average of 27, in my opinion, shouldn't happen until going into earnings, and if the company happens to miss earnings. MACD recently crossed to the downside, but of course the stock was recently raging, so if you bought it a while ago, you're probably not too upset. with the recent drop down. RSI on the weekly as well was up here north of 80. Now we're sitting here, we're still at 65. So that's why if we bear flag and break down, again, we have that moving average, and you can see the mid-Bollinger Band 3080 on the weekly, which is why I'm saying, in my opinion, it really should drop down to around that 30 level and potentially this trend line here. At minimum, we should see this gap fill back to low 32s, if not at least 33, in my opinion. MACD climbing high, starting to curl back to the downside. So that's why they might not completely tank it, but if they slowly bring that down, you know, maybe meet up and then bounce going into earnings. So that's why I'm saying it could potentially fizzle out and cool off a little bit over the next 1 to 2 months going into next quarter's earnings. But let's check the pivot points real quick. I'll let you go. 32.91 support level pivot point on the weekly, which again, the gap fill was 33.01, so we'll pull back to 32.91. Really shouldn't be, was that this high as well? No, that was 32.15, low 32.33. So yeah, that's why it can potentially come back down to there, retest, maybe quickly break to around 30 and then come back and try to reclaim it. 39.22, you can see big drop, tried to get back above and did get back above that mark and then reject, and technically, which is why again we can you know, see a little run up, maybe back above that mark, and then it rejects again and pulls back, and it might complete the flag and then drop. Could also see 50-day moving average 34.23, pivot point 34.32, so you have a lot of action around there. And then, of course, look, we had the gap fill, that we have the potential gap fill, but you had the stop right at that, what is that level again? That was 30. Yeah, that was like slightly above 33. So that's why, again, in my opinion, low 30s, maybe even sub 30, slightly, in the short term, which, of course, is where I'd personally look to enter if I had cash on hand. And over the long term, yeah, I'm going to say, what did I say, 52.5? I'll stick with that. 52.5 over the long term. But just a couple of levels for you guys to keep an eye on. But TOST technically, yeah, it's been growing nicely. And that's why we, in my opinion, you find companies like this who are growing, increasing their market share. You're steadily seeing like revenue either maintained or increasing. Again, this company a couple of quarters ago, looking at the margins, you can see net margin went from negative to positive. They took that next little jump up in the milestone revenue mark. So yeah, technically, it's companies like this. And then, of course, you wait for a potential sell-off, have it come down, kind of quote-unquote back to earth, fill the gaps, come back down to reality, however you want to say it, and then you step in on the dip, and then you wait for that rebound and that growth. And that's pretty much it. So I'll end it there. Once again, Stocks by the Numbers. I want to thank you for stopping by. If you have any questions, comments, or concerns, drop it down in the comments section. I'm usually pretty quick to reply. Thumbs up algorithm helps me get more eyes on the channel. And of course, subscribe to the channel. That is our handshake agreement. That is how you help me help you. But more importantly, moving forward, like I always say, I understand that markets are rocky, they are volatile, and they are very uncertain. So I want to wish all of you success. Hope everyone makes a couple of dollars. Thank you for your time. Have a good day.